This is Macro Horizons, episode 337, Penance of Patience, presented by BMO Capital Markets. I'm your host, Ian Lyngen, here with Ben Jeffery to bring you our thoughts from the trading desk for the upcoming week of August 18th. As the market is currently pricing in slightly more than 25 basis points worth of rate cuts in September, the parallels with September 2024 certainly are not lost on us. The longer the Fed waits, the more it ultimately needs to cut. Alas, the penance of patience. Each week, we offer an updated view on the U.S. rates market and a bad joke or two. But more importantly, the show is centered on responding directly to questions submitted by listeners and clients. We also end each show with our musings on the week ahead. Please feel free to reach out on Bloomberg or email me at ian.lyngen@bmo.com with questions for future episodes. We value your input and hope to keep the show as interactive as possible. So that being said, let's get started. In the week just past, the Treasury market got core CPI for the month of July that came in at 0.3%, which was as anticipated. Headline CPI came in at 0.2, which also matched estimates. What we saw within the composition of the inflation data was very interesting. Core services increased, with the supercore measure of core CPI services excluding OER and rent printing at the highest level since January. That was somewhat surprising. Perhaps just as surprising was the fact that core goods increased a modest 0.2%, which represented a downshift from what we saw in June. The reason that core goods is so relevant at this moment is this is precisely the area in which one would expect higher tariffs to translate through to reflationary pressures. Now, the fact that we haven't seen a material uptick in core goods for either the May, June, or July series now has investors questioning the degree to which the trade war will ultimately be reflationary. There's also an argument that to some extent it has been inflationary, but it just hasn't translated through to the magnitude of core price gains that one might have otherwise expected. If that is in fact the case, and for the August data series, we see another overall benign 0.3 print, which should translate through to a 0.2 core PCE measure, then the amount of rate cuts currently being priced in for 2025 starts to make a lot more sense. At present, the market is currently pricing in roughly 2.5 quarter-point cuts. That's consistent with our thinking, as we have long been in the September and December rate cut camp, with some probability that the Fed chooses to go in October as well. We maintain that the economic data on offer between now and the September 17th FOMC meeting will be more influential in determining whether or not the market prices in fully an October cut than it will be determining whether or not the FOMC chooses to go 50. We're in the quarter point cut camp for September, but are cognizant that the market will attempt to price in some meaningful probability of a 50 basis point move. Now, that might ultimately be a function of the August payrolls report, but more than likely, it will be a combination of the August payrolls and the August inflation data that will press the issue and ultimately drive pricing. Again, we expect that multiple quarter point cuts are far more likely than a 50 basis point move in September. The market will also be closely watching the evolution of the labor statistics, and in the context of the changes at the BLS, With Trump replacing the head of the BLS, there's been questions of the credibility of the data itself. We suspect that the most durable takeaway from the drama at the BLS will be a re-emphasis on data that's being produced outside of the government. For example, the relevance of the ADP measure just increased, as did the ISM and PMI series. This will hold true for both the growth and inflation aspects of those releases.
For all intents and purposes, coming into this week, it was going to be the last real macro event of the summer season, with a nod to Jackson Hole, but it was CPI, and the, as expected, maybe slightly softer than the whisper number the market was looking for, read on consumer prices in July, that has now all but cleared the way for the Fed to resume its easing campaign next month. An as-expected increase of 0.3% month-over-month on core CPI was backed by details that showed goods ex autos climbing just 0.2% after last month's 0.6 gain, and this helped assuage concerns that tariffs are on the precipice of starting a goods-driven increase in inflation, and that would box the Fed into the corner of not being able to cut because inflation was on the rise, at the same time that the labor market was starting to look increasingly shaky. To use July's inflation data as an example, we've made it another month without that happening, and so the employment side of the dual mandate is likely going to be in the driver's seat heading toward the September meeting.
One of the arguments as it relates to goods inflation is that simply because we haven't seen it in April, May, June, or July doesn't mean that it's not coming in August or September. And while that certainly is true, the counterargument is if it takes until August, September, or even October to be realized in the data itself, then, as you point out, Ben, it's simply not going to be as impactful to the macro narrative. And frankly, it's probably more likely to be characterized and truly viewed by the Fed as a one-time price adjustment that doesn't then trigger a fresh round of goods inflation elsewhere. The one troubling aspect of the July CPI release was the supercore measure. It printed up 0.5%, which was the largest increase since January. Now, recall that the supercore measure, defined as CPI's core services excluding OER and rent, has the highest correlation of any of the subcategories with nominal wage gains. So in the event that nominal wages begin to surge again, and supercore inflation remains at these levels, the Fed could be faced with a fresh inflationary problem later this year. Now, we don't think that this risk is sufficient to keep the Fed from cutting in September. However, as the data comes in and the market gains a better understanding of the performance of the real economy, the debate is going to quickly shift to whether or not the Fed cuts in October and December.
And beyond just the question of a 25 basis point cut in September, there's a growing contingent of our client base that is starting to discuss the probability that the Fed does need to go 50. And while it's probably too soon for that to be a base case, especially before we get August payrolls report, assuming it doesn't get canceled, what that is going to mean is that the question is going to become the durability of the labor market into the fourth quarter and what that ultimately will translate to in terms of what rate cuts in 2026 are going to look like. To see the response in the shape of the curve, especially 5s 30s that steepened back out above 106 basis points and 2s 30s that similarly made it back above 115 basis points, the reaction in the broader rates market follows intuitively in that there's a growing chance the Fed is going to need to do more in terms of cuts in an environment when maybe the growth outlook isn't super optimistic, but nor are we on the precipice of a recession, and there are still, even after CPI, upside risks to inflation as a result of tariffs, and now as a function of a central bank that's presumably going to be dialing back its level of restriction. So to look at Wednesday's curve move in isolation and the twist steeper in the shape of the curve, it makes sense to see the two-year sector outperforming, while the long end incorporates a larger premium to account for a less restrictive Fed and the upside risks to inflation in the medium term.
This is the most typical way in which the yield curve prices in term premium, i.e. the front end of the market rallying while 10s and 30s underperform but continue to see lower yields in outright terms. Taking this dynamic and putting it in the context of what the Treasury Department is attempting to do by increasing the size of their liquidity buybacks, it's important to keep in mind that surely from Besant's perspective, The recent re-steepening of the curve is by no means as troubling as had it occurred in a bearish fashion further out in 10s and 30s. So, said differently, even though 5 bonds push to 106 basis points, it's unlikely to be setting off any alarms at the Treasury Department.
And there's another potential paradigm shift on the horizon as it relates to the release of economic data. We heard from the newly appointed head of the BLS this week that he favors scrapping the current system of payrolls released every month until data quality can be improved, and instead something like a quarterly release of the hiring figures for the U.S. makes more sense at this juncture. We're certainly sympathetic to the challenges of data collection and truly getting an accurate picture of the domestic labor market. And the fact that NFP is traditionally so heavily revised anyway would mean that if such a change is going to take place, and it's still too soon to say for sure that it will, but that would imply investors would be in the market for a new benchmark of hiring activity on a month-to-month basis. Initial jobless claims come to mind, so does ADP, ISM Services Employment. All of these releases would offer some clarity on an intra-quarter basis if in fact there is a schedule change around the payrolls report. But as has been the case throughout the new Trump administration, it does speak to the potential for more structural changes to the data regime going forward.
And these structural changes, along with the trade war, as well as many of Trump's other initiatives, have rekindled conversations about credibility, and in terms of financial markets, that translates through to the dollar's status as a reserve currency. The dollar has been under pressure and continues to be under pressure. However, the participation that we're seeing in the Treasury market, the relative success of the auctions, and the overall tone associated with U.S. debt suggests that there certainly has yet to be any wholesale buyer strike in the U.S. Treasury market. It's also worth acknowledging that rumblings about a buyer strike have reduced in frequency, which we're interpreting as being a net positive. So not only have concerns about overseas buyers stepping away because of the trade war subsided, but given the August refunding announcement and Bessent's decision to retain the at least several quarters language, the notion that Treasury coupon auction sizes will be increasing to fund the deficit has also been pushed to the sideline. As a result, the Treasury market has been afforded the opportunity to once again return to trading the fundamentals of growth and inflation expectations.
And in the vein of things to be happy about, which are few and far between on a Treasury desk, the performance of the equity market also can't be ignored in terms of what it means for financial conditions, the Fed, and the overall tone of the market. Stocks are continuing to grind higher, and risk assets more broadly are continuing to perform well on the outlook that the Fed is going to start cutting again, and also the fact that, to your point, Ian, growth might not look great, but it doesn't look bad either. And so especially in a world where the Fed is going to be bringing rates lower and there is still ample liquidity in the system, we're not especially surprised to see equities continue their march higher. Now, what this does in terms of financial conditions is complicate the Fed's calculus a bit, and we'll argue moderates the chances of a 50 basis point cut in September, insofar as lower volatility, both in equities and in rates, along with increased Fed cut pricing, represents a market that is doing a share of the Fed's heavy lifting for it. And so had financial conditions been tightening as a function of higher vol, then maybe the Fed would ultimately need to follow through and deliver 50 basis points in September. But to see the performance of the S&P 500, the level of real rates, and the cut pricing that's already made its way into the front end of the curve, there's already been some easing done by the market, even though we're more than a month away from the September meeting.
And that then brings us to one of the primary risks that we have for the balance of the year, and that is an equity market correction comparable to what we saw in April, based on either another phase of the trade war, a real economic slowdown, or an external shock that has yet to be identified. In such a scenario, we would expect that conversations about a near-term recession would once again become topical. If for no other reason, then as you point out, Ben, the wealth effect has been key in driving incremental consumption and arguably contributing to the stickier aspects of inflation. The flip side being, if the bull market in equities continues, it's not difficult to envision stickier pockets of inflation reemerging in the fourth quarter or even Q1. While such an environment may be akin to a version of stagflation, the reality is that given the Fed will at that point have already restarted normalization, it's difficult to envision that we won't get back to neutral in 2026 in light of the fact that anyone Trump chooses to replace Powell will, by definition, be more dovish.
And that leaves an interesting conversation to be had as it relates to the potential for a recession, given that the Fed is going to continue cutting from what is a relatively robust departure point in terms of real growth. Add to that the wealth effect dynamics of what's happening in the equity market, the fiscal boost from the big beautiful bill, and all of a sudden what was once expected to be a year defined by maybe not a true recession, but at least growth much closer to zero, is now looking increasingly like there will start to be some tailwinds for the economy going forward. Of course, this is all predicated on the fact that the unemployment rate does not surge dramatically higher, with everything that means for wage growth and consumer confidence. But for the time being, as long as the status quo persists, our recession worries are relatively muted, and that's saying something for the two of us.
You know what they say, it's always brightest before the fall, and the fall is only 39 days away.
Or the autumn, for those in the know.
In the week ahead, the Treasury market will have remarkably little economic data from which to derive trading direction. On the supply side, we do have the $16 billion 20-year auctioned on Wednesday afternoon, as well as the 30-year TIPS on Thursday at $8 billion. The conversations around a potential buyer's strike have receded into the background, and we're certainly quite content to see that transition. Even despite the series of tails at the August refunding, i.e. the first week of August saw tails at the 3-year, 10-year, and 30-year, there's been a discounting of the narrative of a wholesale buyer strike from domestic and or overseas investors. The fact of the matter is that the sentiment shift as it pertains to the real economy has simply overshadowed supply and demand concerns. This was started with the July payrolls data and reinforced with the July inflation update. What remains to be seen is the degree to which the Fed is going to be willing to message their intent for the September meeting. We do see the FOMC minutes from the late July meeting, in which there were 2 dissents in favor of a dovish outcome. The detail and the tone of the discussion as represented in the FOMC minutes will be useful context as a setup for what one should expect in September. Perhaps more importantly will be the tone coming out of Jackson Hole on Friday. Now, the conference runs from Thursday evening into Saturday, but typically the most relevant tradable headlines occur on Friday morning. Given that this year is focused on the employment landscape, we're confident that there will be tradable headlines that result, and expect that while the Fed will be unwilling to commit to any forward changes in its monetary policy stance, i.e. a September, October, or December rate cut, it is very consistent with Powell's strategy to retain flexibility into the September meeting while messaging that we're nearing the point of restarting normalization. This then begs the question, how much of a dovish Fed Jackson Hole appearance is already priced in? Given the bid for the front end and the fact that we're pricing in more than 25 basis points worth of cuts in September, we think that there's a compelling case to be made that even a dovish, but not uber dovish, Powell on the 22nd translates through to a bit of weakness in the front end of the curve. After all, the Fed has yet to see the August payroll and inflation data. We've reached the point in this week's episode where we'd like to offer our sincere thanks and condolences to anyone who has managed to make it this far. With the potential list of Fed chairs continuing to expand, we've noticed that Lyngen and or Jeffery are conspicuously absent, perhaps simply lost alongside our invitation to Jackson Hole. Again. Thanks for listening to Macro Horizons. Please visit us at bmocm.com/Macro Horizons. As we aspire to keep our strategy effort as interactive as possible, we'd love to hear what you thought of today's episode. so please email me directly with any feedback at ian.lyngen@bmo.com. You can listen to this show and subscribe on Apple Podcasts or your favorite podcast provider. This show and resources are supported by our team here at BMO, including the FIC Macro Strategy Group and BMO's marketing team. This show has been produced and edited by Puddle Creative.
The views expressed here are those of the participants and not those of BMO Capital Markets, its affiliates, or subsidiaries. For full legal disclosure, visit bmocm.com/macrohorizons/legal.